Good afternoon, everyone. Thanks for joining. So a little bit about me. I graduated from Penn in 2006 with a BA in economics. I began my career while I was still attending school at Penn on the private client side as an FA at Wachovia. Shortly after graduating from school, I moved over to the institutional side. I spent time on the leveraged loan and leveraged finance desks at Barclays Capital. And in May of '09, moved over to the buy side. And I'm working now with 10X Capital, which is a $450 million mid-market distressed private equity fund. We focus on operationally distressed companies, and believe that that with operational leadership, we can improve companies not just on the balance sheet side, but on the operations as well. As I mentioned, currently an associate here. During my time at Barclays, I achieved or I earned my CFA. Which I'd be happy to talk about at the end. And all in all, about 8 years in the industry. So, of which 3 on the buy side. So let's dive in. If you have the slides in front of you, we'll skip to slide 4. Different types of investing. Obviously, there are as many different types of investing as there are investors. I tried to put a couple of broad-based buckets here. What I'm trying to focus on here is the hold time, the investment side, and one of the other pieces to consider that will come up later as we start to get into funds and skills and what you'll be doing in private equity is the type of person you are and the type of research you'll be doing. So high-frequency trading, the objective, as it says, captures small, temporary pricing anomalies. So these are oftentimes quantitatively educated people who are going to focus on writing algorithms to capture, minute differences. They tend to hold an asset for seconds, minutes or hours. They're always publicly traded, and their bite size or their percent as that enterprise value is often very small. The research here is done much less into the company itself, and again, more into relative price discrepancies that they can capture. Taking the next step down the line of trading, prop trading, proprietary trading, and this has been in the news a lot with the Volcker rule. Here, you're going to take a slightly bigger position size, potentially. You're going to hold it for a little bit longer, and you're going to try and create value through arbitrage. So you're going to try and purchase an asset and then use your sales desk or other internal controls, often at a bank, to generate interest in the asset and then hopefully sell it at a higher price down the line. So you're creating your own asset, or your own market here. A long-short hedge fund is now going to do a little bit more research into the stock itself or asset in general. And this is important because the type of research you're going to be doing here is going to be a little bit more in-depth. You're going to potentially take a slightly larger position in the asset. You're going to hold it for longer, and you're going to try and capture relative value discrepancies between two correlated assets. So how does private equity differ? Well, for one, they're going to oftentimes purchase a much larger percent of the company than would a long-short equity hedge fund or another type of hedge fund. Two, they can often buy into the private market, or rather more illiquid assets. So as a result, the hold period is going to go up from weeks, months, maybe even just under a year, to 2, 4, 5, 7 years and longer hold periods. The other difference is that because it's an illiquid asset, because the hold period is longer, and most importantly because the equity ownership approaches that 100% mark, they're going to try and buy it at below potential value and then apply change to the company, whether it be through operations, financial restructuring, or the like, in order to surface that value. And then a holding company, so your Berkshires of the world, very famous quote, our favorite holding period is forever, that Warren Buffett believes in. They'll buy any size of a company from the big position he has in Coca-Cola to the much larger position he owns 100%, I think it is, of Geico. And these guys are trying to buy at or below intrinsic value. They're less concerned with the day-to-day fluctuations in asset prices and more concerned with long-term performance of an asset. So as we go down that list there, the types of analysis you're doing is going to change. So a high-frequency trader may do little or no analysis on an individual company, whereas a private equity or holding company analyst or associate is going to do very in-depth, focused research. So that's very important to point out. So what is private equity? Private equity is capital that's often raised either from high net worth individuals, but predominantly through institutional investors. So these are the endowments of the schools that you attend, pension funds. I know 80% of our fund comes from various pension funds. So, New Jersey Teachers is a major investor in our fund, and the like. So it's important to keep that in mind, that this isn't necessarily just high net worth individuals that can be flippant about their money. We take our investing very seriously, not that other people don't, but we recognize our fiduciary responsibility, and it's something that we're sensitive to. Investments are made directly into public or private companies. So this is important because there are different types of private equity investment. You can do, a PIPE, which is a private investment in a public equity. You could do an LBO, a buyout of a public company, where you buy 100% of it and take it private. You can invest in a private company that is already private, and you want to inject it with fresh capital, take the equity, and maybe do bolt-on acquisitions, provide a growth capital for a new product line, or maybe just affect some other type of change. You can also buy various tranches of debt. So you're familiar with distressed debt, loan-to-own strategies where you intentionally make a loan or buy debt at below where you think the equity value is, in the hopes that you can then take control of the asset. So this differs very much from a hedge fund or certainly from a prop trader who's more interested in a shorter hold period once again, and because of the illiquidity of private equity, and that's something really important to stress, because of the illiquidity, it's important that the analysis really be spot on, because you're not going to be able to trade out of the asset anytime soon. And that's reflected in the length that it takes to return profits. Oftentimes, the terms of a fund will be, say, a 5-year investment horizon. So our fund has 5 years to put the money to work, at the end of which we use it or lose it. So we're incentivized to put that money to work. And then we have a full 7 years to realize the profits on that investment. So you may be asking, well, I know of private equity funds that have been around for 10, 20, 30 years. Well, these funds or management companies have several sub-funds. So when we think of an Apollo or a KKR that has tens of billions of dollars under management, these will be in separate funds, Fund 1, 2, 3, 4, 5. Each one has a similar holding or has restrictions on how long they have to invest the assets. Again, the takeaway here is longer hold time, illiquidity of assets, which is important when thinking about, is private equity right for me? Do I want to be locked into something where I have to be a lot more sure about my investment, but I have more time to make that decision? Whereas a trader can maybe have questions that remain, can make a trade, but knows that he can get out of it, he or she can get out of it potentially at a smaller loss than that of an illiquid investment. So what does an associate or an analyst do when they're in private equity? And these are just a couple of the headlines. And I tried to divide it up into what you would be expected to do. So investment communications are usually handled by the controller or the CFO of the fund, and not something often that you're going to be focusing on. Investment sourcing is very important, and depending on what shop you go to, many have a dedicated business development function, and that's important. It keeps the pipeline full. But you'll also be expected to leverage the relationships of your colleagues coming out of school or those that are at other shops, perhaps coming from an investment bank. As seeds disperse in the wind, your friends will land at other shops, and you'll want to leverage those relationships. So you'll be expected to do about 15% of your time in investment sourcing. Portfolio company monitoring is another function that's usually handled by the controller, but certainly something where we want to monitor the performance of our company, make sure they're hitting their monthly and quarterly targets, and so that's something I spend about 10% of my time on. But the remainder, the 75% that I haven't, that's left, is really on investment diligence. And this can be subdivided into a number of different functions depending on, of course, your level and your skill set. So I took a crack at a few. Certainly there's management meetings, quantitative modeling, on-site diligence, internal memorandum, pitching the idea to an investment committee or to a partner of the fund, business-specific analysis. So to the extent that there's a question that has been raised in diligence that you want to prove out in order to substantiate a thesis or to bound a risk, business-specific analysis is something that certainly you'll spend a significant amount of time on. So these functions, though, certainly differ from other types of investing, and it takes, as I mentioned, a type of investor that's interested in going very, very deep. So I would say that one of the skills that's necessary, or that I found to be very successful, is always pulling on the thread. So when you see something that doesn't feel right, you pull on it and go a little deeper, and much like the metaphor, it starts to unravel and you get down to the truth about the asset or about the risk or the market or whatever the case may be. So really, investment diligence is where I spend the majority of my time, and I help drive my team in order to surface those questions and then to answer them succinctly for our senior members.
Excellent. Quick question that we just had to come in. Is there any variation from firm to firm in terms of, you hear that some firms like a Blackstone or KKR, 100% diligence, and, the associates and analysts just tend to be, churning through those versus, let's say, smaller shops, you might get more involved in some of the sourcing. So can you talk a little bit about how those roles might vary by firm?
Absolutely, and if I was going to touch on this on slide 9, but choosing your firm is vital. And there are a lot of different metrics or categories that I looked at, and questions that I asked. And the questions that you ask, which I'll touch on a little bit later, tell the interviewer a lot about who you are, and can certainly differentiate you from other people who are interviewing for the same position. But as Christine said, it's important to think about the relative trade-off, and it's not linear, but the relative trade-off between the size of the fund, the hours you're going to work, the exposure you're going to have to senior members of the firm, the management teams, to other diligence and advisors, the responsibilities that you're expected to fulfill, the structure of the fund. So one of the big questions I had, and why I chose to come into a smaller fund, is that I was coming out of an investment bank as an associate. A lot of the bigger funds wanted to put me into the pre-MBA bucket, and I didn't want to take a job where I had an exploding offer, if you will, that in 2 years I was being asked to go to business school, especially since I had joined in 2009, the economy didn't look great, and I didn't know what it would look like in 2 years and didn't want to be forced to leave and go to business school. It was just a decision that I made for myself. So certainly, the larger the firm, you could argue, if we wanted to generalize, that you're going to be put into a box. You are going to be expected to work 2 years only on modeling, and we joke and we call it a model monkey. And the deal comes in, you do the model, and you push it out the other end, and you don't really get a chance to get into that business analysis that I touched on, or pulling on that thread. You're expected to produce pitches and produce models. So I think there's a lot of value in that. It's something that, again, at a smaller firm, you're going to oftentimes run into smaller deal teams. And this is relevant because now you're going to get more exposure, you're going to get a chance to learn more, and you're going to get a chance to try different things and really contribute differently to a deal than you would with a larger shop. That said, I talked about the business development function at these shops, and they're much more developed at a KKR or a Blackstone than they are at my firm. So one of the risks that you have of going to a smaller shop is that the deal flow won't be at the same pace, and deals want them to. You're going to do fewer deals a year. So if you believe it's important to build up your deal resume because you're trying to make a move down the line and that's something you place value on, absolutely, then in that case, a bigger shop may make more sense for you. So, these are all the types of questions that you want to better understand and ask your interviewer. The reputation of the fund. There's a number of analysts and associates that are leaving every year. What's their general take on the fund? Do they feel that they were given the kind of exposure and training and time in order to develop their skills, or were they, intentionally burned out? One of the things, since we're on the slide, that I would caution you not to choose a firm based on is your compensation. I know that's sacrilegious, and it's hard to believe that that comp wouldn't be at the top of your mind. But at the end of the day, especially for the junior people, there's more to compensation than just monetary compensation. And that work-life balance, it can be cliche, but it is very real. But really, where I place a lot of value is the exposure that I've had, to the senior members of the firm, the level of responsibility I've been given, the opportunity to try my hand at a number of different aspects of the investment process, from sourcing all the way to after we've made an investment. I had the chance to spend 3 to 6 months in various companies working in the operations and getting a better feel for what it means to go back to a model and change that cell and underwrite that kind of improvement. And so I think it's changed the way I look at investing, and it's something that I know, talking to my friends in some of the bigger multi-billion-dollar shops, is not something that they've had a chance to work on. So I think these are definitely questions that you want to be asking for yourself, asking of yourself. Look at the relative opportunities that are available for you. So how can you learn about, going back to slide 7, how can you learn about the industry? How can you, understand, if you don't know the reputation of a fund or you don't know what's going to be expected of you when you get into that interview, who can you talk to and how can you gain some of that knowledge? So certainly Evisors is a tremendous resource. These are, you get a chance to talk to people like myself who have been in the business. I certainly, it was my job when at Barclays and again here at the private equity firm to evaluate resumes and to decide who we're going to call for phone interviews. Based on those phone interviews, it's often my decision, along with the other associate, who we're going to call in and actually speak with. So getting a chance to talk to people who are doing this on a regular basis will give you great insight into where your relative strengths and weaknesses are, how to better position yourself, what are the trends in the industry, and of course some salient talking points that you can bring into your interview. The other thing that it does, and this ties into the next bullet point, which is school alumni. Leveraging your school alumni base. I know I've gotten a number of emails or phone calls over the years, and I'm always happy to give my time to an alumnus. If it's just asking a question, or maybe they're looking for a job and want to know what's available. Building that network, what comes around goes around in this business, as with many businesses, and so you can artificially is a negative connotation, but you can artificially build your network through the Evisors, or you can certainly leverage the school alumni, and that's a tremendous resource. And then leveraging your further network through LinkedIn is very important as well. Certainly, no one can come to Wall Street without reading certain investment books. Liar's Poker is an occult classic. You have to read it, and it's also very entertaining. So I would encourage you to read that one. It has no information on how to be a better investor, but everyone will be talking about it, so you have to know what it is. And then various industry newsletters, company websites. Vault is a great great source into a day in the life. I would argue that Evisors presents a much better picture. I think Vault is written in a very generalist way, and if you want to know what it's like to work at a large, multi-billion-dollar buyout shop, Evisors has someone that can do that. And if you want to know what it's like to work at a mid-market, distressed, newer emerging manager like 10X, that's something that I can talk about. And you really can focus on, I have an interview at this company. I have specific questions about this company. Evisors, I think, is going to be your best resource for that. So what are firms looking for, and how can you differentiate yourself? So obviously, it would be an investment bank and less so at a private equity fund, but you're going to see, they're going to see hundreds of applications for a given position. So it's all about how can you get your resume and your profile to rise to the top of the list. How can you get that phone interview? And more importantly, how can you get your foot in the door so that you're coming in for that face-to-face interview when you really get a chance to sell yourself? So certainly previous investing or analytical experience is important, but it's not a must-have. If you have never been on the buy side or on the sell side for that matter, certainly consulting or other applicable experience is important. What they're looking for is, can you think critically? And does that come out in the resume? So investment clubs, internships, even if it's unpaid, but it shows an interest in the field, and maybe you can then discuss be it some type of analysis that ultimately led to a decision, whether it was right or wrong. You contributed to a process, and that's what they want to see, that you can do that. Passion for investing and general curiosity is important. So, when you go into that interview or phone interview, you want to have examples of what an idea you have and why this makes sense. And even if it's, in their opinion, wrong, demonstrating that you have an opinion, are not intimidated, and are capable of making an argument that's fact-based and can facilitate discussion, that ultimately is the role of the associate, which is to gather all the information, to compile it in a way and synthesize it, and then to elevate it in discussion so that you can have, again, fact-based, meaningful discussion. So, that's not going to come about if you're not interested. The work itself, my wife will tell you she hates when I get with colleagues when we start talking finance. She's not interested and would not be as successful in this field. So if you're just doing it for the money, I would caution you that the hours are too long and the work too tedious. So you have to be honest with yourself about it. But if you have a general interest, or genuine interest, it's a fascinating place to work. And that idea of, wanting to get to the right answer, that's that pulling on the thread that I was talking about. So, can you demonstrate that you have the ability to form opinions and intelligently defend them? Obviously.
So we actually, one quick question there from the audience. In terms of relevant work experience, how important is it that let's say, because a lot of the people on the line here are MBAs, do you need to have private equity experience before your MBA or banking experience? And if you don't, what are ways that you can kind of differentiate yourself when they're looking for this type of skills and competencies?
Absolutely. So I know that we share the opinion of many successful investors out there, which is, show me a smart person and we'll find a place for them. I think that most important, given that initial job, well, I'll be honest, the work that's done, right, knowing how to model is not particularly difficult. It's math and logic, something that everyone out there is certainly capable of doing. I think that it's important to demonstrate that critical thinking. And so in your relevant work experience, I would really highlight, situations where you helped a team to solve a problem by applying either some sort of ingenuity or analytics. So they want to see, are you capable of analysis? Are you capable of developing, certainly a financial model is important, but have you been successful in presenting your ideas to a broader, more senior group? So without a doubt, there's no reason to sugarcoat it. If you don't come from some sort of investing background and you don't have any sort of investment internship or club or other affiliation on your resume, it's going to raise a flag as to why should I consider this person amongst the hundreds of other applications that I'm looking at. But if you can demonstrate an interest, and that's the important part there, and then you can really accentuate the analytical thinking, I think that's going to go a long way. Answer the question?
Yep, that's great. Thanks.
Great. So it goes without saying that a strong work ethic is important, and specifically there in attention to detail. So one of the quickest ways for me to throw a resume in the wastebasket is if I see poor formatting or a lack of attention to detail. And again, these are things that can't be taught. So I think that the general theme here is, private equity firms can teach you how they want you to attack a problem. They can teach you how to model. For $3,000, you can go to Training the Street, and they'll teach you everything you need to know to build a full three-statement model. Again, it's math and logic. What they can't teach you is work ethic, attention to detail, a hunger to get that right answer. They can't teach you, how to think outside the box or how to creatively solve a problem. They can't teach you how to work well with others. These are things that are just, inherent. So I think that it's very important that you prove it through your academic experience and extracurriculars, the ability to multitask and take on a number of different responsibilities and to execute each to a high level of perfection. So, it's important, and one way to do that, as I said, formatting the resume. And if you're unfamiliar with that, certainly something I'd be happy to help with at a later time. So I sort of touched on this a few different ways, but that thought leadership, how do you creatively solve a problem? And for those of you that are MBAs, coming from a consulting, investment banking, or some other industry background, I'm sure you've been forced to confront some sort of problem that wasn't necessarily obvious, the solution wasn't necessarily obvious. And so, comfortably talk about it, of what you did to attack that problem, how it was different or against the grain. Because ultimately, the act of buying an asset is a very arrogant act. You're saying that you know something that the rest of the market does not know. So it's important that you, have that sort of balance of arrogance and humility, but that you can demonstrate a creativity to solve problems where others may not see an answer. And again, these are things that can't be taught, and what ultimately the private equity firms are looking for. And finally, it goes back to the ability to, articulate and effectively communicate your ideas to those that may be more senior to you, more junior to you, unfamiliar with you, or whatever the case may be. So being able to really, distinctly and effectively communicate your ideas, again, that lack of intimidation when someone says you're wrong, and be able to counter with that the analysis and the facts to support your position are very important. We already touched a little bit on choosing the firm, but again, I would stress here that different firms are going to have you doing different things, and you should leverage Evisors and your network to determine what it is you'd be doing, and try to get an understanding from the job description of what's expected of you. Are you going to be sector focused? Doing, let's say, large cap buyouts of business services companies. And if that doesn't interest you, or if you don't believe that that industry has opportunities in the next few years, then you might want to look for a different firm or a different group within that firm. So what can you expect in the recruitment process? Certainly, it often begins either with a call from a headhunter, on-campus recruiting, OCR, or maybe you hear about something through your network from someone that you're speaking with. And, your resume is going to differentiate you. It's the most important tool you have in order to get the job. Cover letter is important, and it should be tailored accordingly to the company and be specific. But again, if you have 100 resumes in front of you, there just isn't time to read all the cover letters. That said, it is a differentiator when you're down to the wire between, someone who may or may not be on the margin. Submission of the application, and you want to make sure that you're following up respectfully but appropriately. My guess is that everyone on the phone today clearly is demonstrating an interest in the field, and it would be a viable candidate, and you're going to make it to the interview. And this is what's going to separate you from everybody else out there. Oftentimes, it'll begin with a phone interview, and the first question I'll usually ask is something to the effect of, tell me about yourself, or walk me through your resume. And what they're asking you to do here, obviously the person that's asking the question knows how to read. So this is a chance for you to tell them everything about yourself that's related to your resume, but that isn't contained in the black and white lettering on the page. So now you get to discuss the nuances or the color around that creative problem that you helped solve at a particular company. You want to move, oftentimes, I find it easiest in a linear fashion, so that the interviewer can follow where you're coming from. So I did my undergraduate work at Penn, moved on to Barclays, and now I'm at this company. I went to business school. I'm graduating in May. Here's what I want to do. Or it gives you a chance to really walk through each, expand upon it, but don't just restate what's on the page. That's going to be a waste of the valuable time you have to grab the interviewer and show him that you bring value to the table. So then they may have you answer basic questions, about why do you want to come work for us, or why do you want to be in private equity. The wrong answer is, I want to make a lot of money. It's certainly, why some of us do it, and it's in the back of everyone's mind, but it's not the answer they want to hear. They want to hear about that, creative problem solving and the desire to get the right answer, and that you enjoy research and pulling on that thread. And again, this is a great opportunity to tie it back to something you've done. So don't just tell me why you want it. Tell me, I really, enjoy creative problem solving. I know one time when I was at, and you get to go back to that example and tell them about it. And you want it to be a dialogue. If they're peppering you with a question and you're going on as a monologue, that's a very uncomfortable situation. And it's not something that will ultimately leave the interviewer with that feeling of, I like that person. They seemed intelligent. They seemed like they'd be a good fit here. To some extent, they will ask you technical questions. So my two favorite are, walk me from EBITDA to unlevered free cash flow, or maybe levered free cash flow. And the purpose of that question is that it tells me, are you familiar with how the various financial statements interplay? Are you familiar with the drivers of a business cash generation, which is ultimately why you want to buy an asset in the first place? Another question I like that's a little bit more technical, and it really depends on the level of an applicant, but I like to ask about working capital. And working capital is very important because it really plays into the operations of a business, but also your technical understanding of a balance sheet and cash flow statement, and it'll really surface whether or not you just memorized a formula or if you know what you're talking about. So I would ask a question like, if accounts receivable went up, what happens to working capital? Is that a source of cash or a use of cash? And that's just an example that, again, really surfaces whether or not this person has the interest in finance that we talked about. They have the basic technical skills that are quite frankly teachable, but are a foundation for success. And it's something that you'd be surprised the answers I get. I would argue that the most important question you're asked is walk me through your resume or tell me about yourself. The second most important question they're going to ask you, and it's often a throwaway that I've heard all too many times, is, do you have any questions for me? Do you want to have questions for your interviewer? This is a chance for you, to really go back what we discussed. To go back to what we discussed a moment ago on choosing the firm that's right for you. This is a chance for you to ask about the firm, the culture, the fit. It's a chance for you to get to know your interviewer a little better. Again, building that rapport is going to be very important after they've seen 25 applicants when they go back to their colleagues and say, this person stuck out. What made you stick out? It wasn't because you got the technical question right. It was because you somehow were able to hold a conversation with this person. So, what would my responsibilities be? What kind of exposure would I have? What kind of sectors would I get an opportunity to focus on? again, culture, the interviewer's background is very important. I would say that this is not an opportunity, and I actually had an applicant ask me once about compensation and salary. That's not what they're asking here. Again, this is a culture fit type question. It should be a softball and an opportunity for you really to draw the person in. I remember I was on an interview once, and I saw that the person had a picture of their family, or what appeared to be their family, on a ski trip on their desk. I'm an avid skier, and now we got to talk about our favorite ski mountains in the country, and that was great, and I think it built a great rapport. So have questions ready, think about them ahead of time, write them down, bring a notebook, pen, and pencil into the interview, and it's okay to ask questions. And to that end, take notes. When they say something, you want to make sure that you are at least appearing. Certainly, I know the job market's tough, but you're appearing to interview them as well, because that's very important. Not every firm is going to be a fit for you, and taking a position because either it's the only one available, certainly can understand that, but something that you want to be aware of and make sure that you understand what it is you're getting yourself into. I really appreciate everyone's time and listening. I'm happy to take any questions that you may have at this time.
Perfect. So we do have a few questions, and I encourage people to keep typing them in. You can either type them to all of us or just the host. But the first one is with regards to first and second round interviews. How many rounds did you expect going through a typical private equity interview? And then is there any big differences between the various rounds?
Absolutely. So I think that it's the first question about how many did I expect goes back to being a function of the size of the firm and the structure of the recruiting process. So a well-established, larger firm is going to have a very structured recruitment process. They're going to be focused on certain schools, on certain investment banks, on certain consulting firms, and they're going to leave a few spots open for alternative candidates as well, but they're going to have a very structured approach, and they're going to be looking for something very specific. To that end, in the first round, it's often a combination of a fit and technical ability. So they're going to want to understand that, they're going to want to know that you understand the difference between an income statement and a balance sheet and a cash flow statement, and that you can generally just, have a technical conversation. But again, it's going to be superficially technical. Depending on the position that you're interviewing for, it's the second round where they may or may not, again, depending on the seniority of position, really start digging into the technical ability. So for an associate coming out of business school, who will most likely be hired as a senior associate, they're going to focus less on the ability to model. They're going to assume that you've done that. Certainly, you'll have to understand how to do that, but there probably won't be a modeling test necessarily. Instead, they may have you do a case study, and this is an opportunity for you to demonstrate that quality of thought that we talked about. So often 1 to 2 rounds, maybe if it's a more competitive process or a smaller firm where they really want to make sure that it's a great fit. I know at our firm, nobody is hired without meeting every single one of the partners and almost all the associates to make sure that that it's a good fit. At a bigger shop, that's not the case, and it may only be 2 or 3 rounds, but you're going to be scored very objectively. So I would expect that, certainly a phone interview, a follow-up in-person interview, and potentially one other. Maybe there's a take-home test in between where they evaluate your quality of judgment, investment judgment, and you want to make sure that that on those second and third rounds you're really pressing the fit as well.
Excellent. So we have one other question on related to geographic differences. So a number of the people on this call, they're going to a European business school and come from different parts of the world. So is there anything particular about private equity in other geographies, whether it be Europe or South America, that is maybe different than North America?
Sure. I think that the answer is yes. I don't want to talk out of turn because I haven't done enough work with colleagues overseas or in LATAM to really be able to speak more intelligently than the following, which is, I know in certain economies, the private equity is just beginning to develop, whereas here in the United States, when a company is looking to do something, be it an acquisition or a growth strategy, go private, whatever the case may be, they're always going to look for private equity as well as the public markets. In other countries, for example, Brazil, Mexico, and some of the other larger but still emerging markets down in South America, that's something where maybe the first call from a banker is not to the private equity, it's to some sort of strategic. And I know the same goes for Europe, is somewhere in between. That said, I think that the way that business managers in the various countries run their business also determines the type of ultimate investing that's available to private equity. And what I mean by that is in certain economies, working capital has a huge premium to it. And as a result, business managers are very careful with how they use their working capital. Consequently, when private equity comes in, there's a much larger premium placed on that fresh capital, and so it may be looked at a little bit differently for the type of investment that's done. So I think that from a compensation standpoint, I don't think, for the most part, people that work in private equity across the globe are fairly compensated or equally compensated. I think that from a responsibilities standpoint, it's more of a function of the firm and less so of the geography. And then from a sector or business, what they're going to focus on, it tends to be more a function of what is the economy of that country or that region. So maybe in certain, if you're investing in certain parts of Eastern Europe right now, it could be more of a manufacturing based approach, or China for that matter, whereas in the United States and maybe in Australia, it's more business services and less of manufacturing and production. So again, something to think about in where you choose to focus. I would say that language barriers are important. My Spanish isn't nearly proficient enough to be able to do business in those regions, and so it was important for me to focus on North America. To the extent that you have, that you are a bi or trilingual and then some, that's a huge differentiator to be able to be, to bring to the private equity community in these countries and regions.
Excellent. And then kind of building on the relevance of the economy in private equity, clearly there's a lot of issues both with, the European debt crisis and kind of the overall global economy. How do you think about careers in private equity kind of within this economic context? Like, is it less attractive, the same? What's kind of your thought on that?
No, I think that's a great question, and that goes back to the relative holding period of private equity vis-a-vis, prop trading, algorithmic trading, or hedge fund. Private equity has a longer lockup on the money of at least a 5-year investment horizon, 7-year realization period for any given fund. And the private equity fund may be in between funds. So they may have 3 years remaining on one and 7 years on the other. And so that overlap leaves a lot of capital available. Because of that, and because you are holding assets for a longer period of time, it goes back to buying an asset at its intrinsic value or below its potential value, and then applying leverage. And I don't mean financial leverage. I mean, whether it's the network of the private equity fund or other business leaders, and you can bring that to bear and surface that value. What's happening in the macro economy is relevant. Certainly, you don't want to be investing in an aerospace or defense contractor to the U.S. government right now. That's getting a lot of pressure to cut the budget. That could be something that would worry you. But if your investment horizon is much longer and you believe, and this is one of those risks that you would have to box, and the research you'd have to do to demonstrate that you can get the firm comfortable with this risk. But if you can demonstrate that this risk is temporal, and that 5 years from now, when we're going to exit the investment, it won't be an issue then, and more importantly, over the immediate term, whatever happens in the macroeconomy doesn't necessarily affect the competitive nature of this company, then it still may be a good investment. And because it's a private investment, you're not subject to, daily price fluctuations that play havoc on your psyche. Instead, you get a chance to either mark it quarterly or even annually, depending on the requirements of your limited partners. And it's a chance for you to actually take advantage of friction and dislocation that we're seeing in the market. So for a fund like us, asset prices are depressed right now, and we think it's a fantastic time to be putting money to work, given our longer time horizon, illiquid nature of the asset, and private valuation. So certainly something to consider, something to have an opinion on as you go into these interviews. They may absolutely ask you whether or not you have an opinion and how you think it could affect a certain investment. So that's a chance for you to demonstrate, again, going back to your interest and knowledge in the industry. But I don't think that it necessarily affects the viability of the private equity model or the compensation for its participants.
Excellent. Well, thank you very much for that. Just recognizing the time right now, I think we're going to wrap up. If there are any other questions, please do type them into the text box right now. Other than that, the other thing I would mention for those of you on the line is your career services has purchase sessions on Evisors. So you just need to talk to Rosie Innes to get access to Evisors for free. Book sessions with people like Arion today or any of our other experts in private equity. So with that, I think we're going to wrap up. I guess as a final question, what would you say is the kind of the thing that you learned most or was most surprising joining private equity versus before you got there?
Excellent question. I did a lot of research ahead of time, so there wasn't necessarily any earth-shattering revelations that came about. I would say that the pace with which investment process moved was slower than I was accustomed to, coming from an investment bank where everything was mission critical and time sensitive. When you have the money and you're the one making the investment, things can move at your speed. So that was one thing that surprised me a little bit. And the second was really stressing the illiquidity of an asset. It was very important that we become incredibly comfortable with all the risks. And so talk about pulling on that thread. I thought that was a skill of mine, but something that we just keep pulling and pulling and pulling to the point where, I want to pull my hair out. But, that's the role of the senior investors and the advisors of our firms to make sure that we've really exhausted everything. So those two pieces surprised me somewhat, only to their degree, but certainly not to their, the fact that they existed.
Fantastic. Well, thank you. And I know it's a bit of a curveball question, so I appreciate you answering that. Thanks again for everything and presenting.